also joined by a panel, and I'll ask them now to introduce themselves from over there to over there. So, do a little bit of housekeeping before we begin. We're going to go through the teams. We will check the audio we'll be speaking in, and we will check if there's any particular way you'd like to be referred to. We also need you to let us know that you're happy to be streamed, because this room will be streaming. So, in opening government, and audience, please can we applaud when we get their teams? Okay, good. In opening government, we should have TCD Phil A. In opening opposition, we should have Edinburgh A.
Jamie speaking first, Phil A please, and I'm happy to be streamed.
Kara speaking second, EUDC, happy to be streamed.
Okay, in closing government, we should have TCD Hist B. And in closing opposition, we should have Vienna A. Okie dokie, standing orders are as they have been throughout the tournament. Did you two consent to being streamed?
Oh, yeah.
Yeah, cool. Standing orders, same as throughout the tournament. At 1 minute, points of information can be offered. You will hear. Do you hear the clap? No, I don't like dings. I don't like dings. I'm too much a clapper. 6 minutes, the same sound. Clap. 7 minutes, 2 claps. Means you're out of time. You should begin wrapping up because at 7 minutes 15, I will clap twice again to let you know that at that point we won't take any more notes. But it's the semi-finals Euros. Do whatever big dramatic finish you need. Okay. It's possible you won't hear the claps, so I strongly encourage you to keep each other's time, keep your own time, and only offer points of information at the correct time. Hopefully, there are no questions or burning issues or things because we've been doing this for however many days now. Some of us more than others. However, in that case, on the motion that was up there a minute ago, I'd like to call upon the Prime Minister to open the case for opening government. Hear, hear.
Enough 10 kuna. The winner gets the 10 kuna, right? But not to invest. Panel, I know me and Dylan are known as the guys who study philosophy, but what you may not know is our full degree is philosophy, politics, economics, and sociology. In 2011, we saw people who individually decided to invest in relatively stable assets by themselves. This was before the significant increase. They look like people who are familiar with economics and have studied it deeply, such as ourselves, but also things like middle-class people who just wanted to avoid things such as inflation. They're the ones investing in the Dow Jones, in the S&P, not necessarily Tesla, GME, and these kinds of stocks. They were in very stable things. What was the rise? We say the rise was due to 2 things. A, like online communities such as Wall Street Bets, which is the subreddit involved in the huge GME crash that I'm sure we're all familiar with given that was in headlines. Then in these instances, you have people riling up and constantly expanding their friends, people within other subreddits to attract people in, saying, hey, this is a great way to make money, as long as you like keep diamond hands and so on and so forth. Crucially then, this is a way to attract people in who otherwise would not have been necessarily doing it or necessarily had the knowledge or conception that they should be doing this in themselves and have the expertise to do well in it. But secondly, it's also the increasing services. Because in the past, it was actually kind of hard to be a retail trader. And look, we're willing to trade this off because it's a bad decision to make. And money within capitalism is agency in and of itself, as it allows you to have money to make future choices in your life. So crucially, I don't care if like, oh, we get eToro, all these other huge apps, and you can choose between them. I don't care, it's a bad choice, and it limits your other choices in the future. Crucially then, these services then heavily advertised to people. Question though, who would they advertise to? Well, obviously you're not going to advertise to full-on gamblers because they've already wasted all their money and they won't have that big a portfolio. But you're not going to take, you're not going to advertise to people who say, aren't into gambling at all, who aren't risk takers whatsoever. What you probably do is you play up to people and say, hey, you're probably really smart. You can be just like the big guys in the suits on Wall Street, these kind of things, you're really good. But also this is a class way to making money. If you're down and out, if you're struggling to pay rent each and every week, cool, invest it. You'll be able to still pay your rent, but you'll also be able to take a skim off the top each and every time. People who are desperate, people who needed money, are the ones who obviously algorithms would push towards because they're most likely to then follow in on this app. And if that's true, they're the ones who do it. So even if the advertising was inaccurate first, they do it, they see the returns, and then they profile the same people with huge trends that exist across the data on social media. 2 claims in this debate then based on this huge characterization. I say, first of all, that multiple lives have been ruined. And secondly, the lives of those who partook in this, but also lives of those who did not by risk and communal collusion, which we say is wrong in and of itself. Why were lives ruined? Because these people were pushed towards high-risk stocks without the ability to diversify. Because obviously you do want high-risk stocks, that's how you make money. And the idea of this was you are attracted to make money. But because there are people who are not that well off, at least the ones that involved in a significant rise, they couldn't also invest in the S&P, or they couldn't also invest in Google or Alphabet. So crucially then, they are hugely at risk and dependent on this stock. Why were they pushed towards this way? A, the attraction that this is a moneymaker in and of itself. The way that this is advertised is obviously you don't go to someone, hey, do you want to avoid inflation by investing in the S&P? Who gives a fuck? You're not going to benefit too much, and like your purchasing power is slightly better going into the future. People don't care. The big thing where it was advertised is things like actively, you can make loads of money, you can move houses, you'll be able to afford that next present that your next Valentine's or Christmas or whatever. Crucially, then this is a far bigger attraction thing, meaning that you follow up on it. When people have been attracted in this way, they don't go to those stable stocks because the very advertising which they brought them in also told them to invest in a certain kind of stock. Why do they do this? 2 reasons. It's A, because you have to constantly attract new people, right? So that's the best way to do it because you want to make money. But 2, because the way that these work, these apps and these platforms, is they say themselves, we do not take commission. But that's because you're not buying the stock from them. What they do is you tell them to buy the stock, they go to a clearance house, which are the people who actually trade on assets and equities on stocks, different stock exchanges across the world, and the clearance house takes a commission every time. And these apps have deals with the clearance houses to make money because you can advertise and say, we take no commission. You think, that's fucking class. Aren't they treating me well? So it's the best efficient way for them to attract people in while making a huge amount of money. What's the problem with this? Because clearance houses, they don't necessarily say, we take X% of each investment you get, especially these kind of clearance houses that are trying to attract retail investors. Why? Because they're not trustworthy. What is trustworthy is that they will make multiple investments. If you constantly have people moving around their assets constantly trying to make new riskier bets all the time, they actually make more money on that than someone having maybe a smaller percentage of a bigger thing in the long run. Because crucially, it doesn't matter if they make money, it matters that they constantly are taking things in and out of the clearance houses because it's using your time and that's what you charge for. So that's the commission you get. So then the companies, because they want to have the best relationship with clearance houses, push people towards those same things so they get the best rates and so on and so forth. What does it mean? It means, one, you simply play to people's spiteness and protagonist bias. They're willing to buy into this because they think, yeah, I can be like that Wall Street trader. Nothing bad will happen to me because you don't want to conceptualize bad things that happen to you because that seems risky, it seems sad, you avoid those negative thoughts. So you go towards the really positive. This is going to work out brilliantly, this is going to be class, so you follow up on them. But secondly, there's the inflation in and of itself, not necessarily something which is good, but with a huge amount coming in. But there's another reason here, and that is the idea that the crypto lobby is actually heavily invested in this because it's the same kind of venture capitalists involved in these new platforms as the ones heavily invested in crypto. So when you go on because they own both and they want you to invest in crypto, especially because they were the original owners, the ones who actually made all the fucking money off Bitcoin before the crash, because they invested back in 2005 and it was like €5 instead of whatever 1,000 it was from that fucking Imperial info slide. And it's the idea that crucially then, you have this is actively pushed towards you in huge ways, and we've seen the crypto crash in and of itself, so I don't even need to justify why it's wrong or why it's risky, because we've seen it fucked up no matter what. What is the high frequency? There's another aspect though, because you're never able to compete, even if you try to do good bets. Why is this the case? Because proper stock exchange, like proper hedge funds, that's the word. What they have is these like language-generated AIs. They have high-frequency trading algorithms which are able to, when the stock exchange opens, they can project whether, like based on a modeling, whether or not a significant asset it's rising or dropping in value, even on the cent or cents of cents level. In these instances, you're able to continually go trading in and out, in and out, in and out, so you constantly bake the curve. Because people think of trading like, they go up in one quarter, down in quarter. No, it's you constantly are like this all the fucking time because there's a new things, there's new investment. Another news came out across the world because the economic system is so complex that trades go up and down, but it's also about perceived confidence. So it's about who's buying. And if you are buying, they're going to go, crew, we'll like short this, we'll future it because then in the future it'll be worth more and we'll get them to short it. POI?
Yes. Is your metric that if I have more money necessary, that will always make me happier no matter what?
No, I think it gives you more choice in life, but close enough. Right, crucially, what do we say past this? We say then, this means you're not able to compete because you as a retail investor, you have to be awake to trade at the right times of the stock exchange are open. You don't have the algorithms to do it for you. Because you have to manually trade each one, you don't have algorithms doing multiple trades at a single time. So you're just never going to be able to compete against this. What does this mean? It means one, huge wasted money. Often people who needed it get based on the characterization of who was targeted from this. People who are exploited within this competition because the hedge funds they could never compete, so weren't afraid. But secondly, you just played it as a learning curve, right? Because even when people start to lose money, you go, don't worry, you haven't learned it yet. You're starting to pick up, but you should keep investing because your next investment will be better. We can give you all these academies, we can give you these tips. but you're never going to be able to compete anyway. It's not about your ability to, it's not about your capacity within the brain, it's your about ability to actually trade as quickly as everyone else. Meaning, crucially, we have people missing rents. We have people not having the ability to buy what present they want and have less choice within their life. Then we'll expand on the risk of communal collusion, but this is obviously not as important a thing within the debate, if also CG tried to expand on it, because we all know it in the news, and everyone knows it was a bad thing. And we all see the way that damaged people, pension funds were involved, had to be bailed out, which came from taxpayer money. Ultimately, I hope you guys have spec knowledge. Cheers.
I'd like to thank the Prime Minister for his fine speech, and I'd like to call upon the Leader of Opposition to begin the case for open opposition. Hear, hear.
Okay, we good to go, panel? Okay, starting in 3, 2, 1. Why doesn't this bankrupt people to a significant degree, clashing directly with opening government? Understand that most people who do this type of investing tend to do so sensibly. That is because, A, a lot of the individuals who do this are hobbyists, so they do things like following financial news and advisors. They go on Discords and Reddit to become highly educated about how the financial system works and how, for example, hedge funds are operating, so that they're aware of the ways that they're trying to trick you and can try to, invest in ways that don't necessarily allow the hedge funds to win. That means that in most cases, people probably aren't making very stupid decisions. They probably have things like to highly diversify portfolios, so a lot of their money isn't just in one stock that then crashes and then they lose everything. But secondly, people don't tend to invest too much of their savings anyway. So for example, the average investment in like GameStop was under $100. That's important because it means that people don't go bankrupt when things go wrong. So even if people are always being outcompeted, they're not actually necessarily losing that much anyway. That is because people don't have that much money to invest when they're just average citizens, and they also are just like relatively risk averse and don't want to lose all of their savings, and so they're not willing to take on massive degrees of risk. I just want to know, if people are really always just being outcompeted by hedge funds, I just think in most cases they stop investing in those funds anyway, because realistically, in most cases, if you're always playing a losing game and losing money, then most people are going to stop doing this. So it is very clear that people, given there has been a significant rise, have been able to make money from this and see it as something that is beneficial for them and are able to take like some stuff. Anyway, note well that this debate is about the significant rise too, so I think a lot of the crazy gambling lunatics that they want to talk about probably exist on either side of the house. That's not the average person that we're talking about in this debate. Our case in opening opposition is going to be about why it increases financial literacy among the population, why this presents opportunities to increase your degree of income and also your degree of income stability, and secondly, why it also leads to better regulation of the financial system as a whole. Understand that, firstly, how do individuals become financially literate? There are many online resources that are of high quality for you to be able to do this. So people who are investing do things like following financial news, not just listening to whatever eToro tells you. They do things like following advisors on Twitter who tell you about what is happening in the market, and these are people who are constantly following what is going on. They do things like joining Discord servers where there are hundreds and hundreds of people monitoring the markets at all different hours of the day, meaning that you're able to access a reliable flow of information about what has happened. You take advice from people who have previously achieved success and have been able to construct expertise and authority in these communities. And in general, given that these people have achieved success, they tend to know what they're talking about to a certain degree, because obviously if you've been able to make money from this, then you can tell other people about how they can make money as well. What types of things do they end up understanding? A, how financial markets and the financial system works as a whole, given it is core to understand how things like stocks and equities and debt work in order to be able to invest successfully. Second, they understand what risky investments are, so they know how to understand whether or not something is likely to make a lot of money, or when specific types of investments are very, very risky and are likely to fail, given that most people, again, don't want to lose all of their savings. I think they have large incentives to learn this. But third, they also understand how to make investments that are likely to win and how to play the financial system to their advantage. First, why does this lead to better social mobility and income stability for these individuals? It's because people invest in stocks, and it's literally just another source of income that you can get. Note well, again, people are relatively risk averse, and they don't want to risk all of their savings. They know that this will adversely affect their own life, their family's life. It will adversely affect their pension in future. I also think you just do things like reading horror stories on r/Wall Street Bets about people who have lost everything, or you read horror stories about the fact that people lost all of their income in the crypto crash, and so you aren't willing to put all of your income in here in the first place. The impact of this is not that people get crazy, crazy rich from investing, but rather that they have another income stream that can help them out. And it's importantly comparatively better, because if that money was just sitting in a bank otherwise, they would be making less money on it, because interest rates in banks tend to be lower than the degree of capital that you can gain from investing in stocks that rise a little bit more. That just means that people have more money on our side of the house if they're making these good decisions, which is obviously good because it means they can afford more things and they don't have to worry if something goes wrong in their life. But secondly, it provides an additional income stream that gives them more stability. So if something happens, like you lose your job, then that means you have some other options too that you can fall back on, which is not something that you have in the comparative, where most of your money is probably stored in a bank. That gives people people a greater degree of stability, and it means that when things go wrong, they aren't quite as fucked, which is probably something that is good for them. Secondly, we'll talk about why this leads to better regulation of the financial system. I think it's important, again, to note that people understand how the financial system works better, and they understand what is risky to a greater extent. The important implication of this is that people are better able to hold their governments to account in terms of regulation of the financial system. It means you can do things like calling out the government when they allow inherently risky policies and regulations on the financial system. Things like not adequately addressing the problems that existed with banks and with Wall Street in the wake of the 2008 crisis. Things like, in the UK, slashing pre-checks on mortgages once again, which again allows banks to give people really, really risky mortgages, which massively increases the risk of another housing crisis happening. This is important because it means that, A, people are able to vote against stupid policies, which means that governments, and I think importantly, when you understand the significance of the financial system, you know how it affects the entire economy as a whole, given it's all built on stocks, and you know how it affects people's pensions and people's savings to a great degree. It's something that's likely to enter your voting calculus to a high degree, because obviously the state of the economy is something that's just very important to most people in terms of the fact that it affects literally everything in your life, what kind of car you can buy, what kind of things you can buy for your children, whether you can afford food at the end of the week. This means that it does enter people's calculus to a great extent, and that's why they're willing to vote for governments who are more sensible and are going to pass more sensible regulation on the financial system. I'll take CG.
So your logic is the status quo where individuals may have investments in large hedge funds are now likely to vote on economic policy that reduces their ability to profit.
No, but because people don't just invest in large hedge funds, people also invest in individual companies by themselves, right? So this means that people are still willing to vote for these types of regulations. But regardless of that, I think when people understand why even if they are investing in those hedge funds, when they understand that what those hedge funds are doing is inherently incredibly risky and is likely to, fuck up all of their pensions, then I think people are willing to regulate those hedge funds regardless, because again, it's going to destroy your life and destroy your family's level of economic prosperity if the entire economy crashes in the way that it did in 2008 once again, which means that even if you do invest in those hedge funds, you're still going to want to have greater regulation on them, and when you understand why what they are doing is risky, that is the only situation in which you can actually do this. And I just think on the comparative, most people don't understand financial markets because there is literally no education on it in most schools in any country in the world. It's also just very, very complicated, so the average person just doesn't really understand what risk is associated with housing mortgages. But when you have to understand it because you have an income stream that is reliant on it and you have to make decisions as to where to put your money, then you are much more likely to have that understanding that you need to be able to vote appropriately. But secondly, it forces governments to mediate their economic regulations and policies to a more financially literate voter base. That is, they're already less likely to even pass the stupid regulation in the first place, so you don't actually have to vote against it, because they know if they do propose something that's just very, very dodgy, that has a risk of crashing the entire economy, then more people are going to be able to call them out on it immediately, meaning that governments, again, have more of an incentive to actually have financial regulations that are genuinely going to be better. I think this means we safeguard the financial system from further crashes, which is obviously much better for the average person. And I want to note that this stands independently even if people suck at investing. Oh.
I'd like to thank the Leader of Opposition for the fine speech, and I'd like to call upon the Deputy Prime Minister to continue the case for opening government. Hear, hear.
I saw a bee drown in his own honey, and then I understood. The unfettered pursuit of capital in the human mind must be tempered by regulation or norms, and in the absence of this temperament, we lose what we need the most. I'm going to first respond to opening opposition. The first thing to say is all of their analysis about why you seek out information to make sure that your bets are secure does not matter, because the individuals with the greatest capacity to set the agenda about what constitutes a safe investment are by definition those with the most amount of capital to do advertising, to do, owning those Discord servers, to do those kinds of things. By definition then, those individuals don't have the same incentives as the investors, because they already have stocks in a number of different markets and have the incentive to want people to buy up a load of those stocks in order for them to then later sell those stocks, i.e. a pump and a dump scam, and that happens to a lot of individuals on the ground. Second primary response is that OO presuppose a rationality of actors which we have already contested and never got a response. This is to say, we explained to you why individually these companies like eToro have the incentive to try and find individuals with who have are risk takers inherently, right? That is the increased delta of this that happens in the consequence of this motion. What this inherently means then is they have things like protagonist bias. If they don't perceive an element of risk in these kind of things. They're able to have their fears or like their hopes of, you know, a massive life with huge amounts of fame, celebrity, fortune, the ability to retire rather than just living their mundane life. Those hopes are weaponized against them such that they believe that even if this bet didn't work, I just needed to work harder. I needed to be smarter. I needed to be better. And that is how I'm going to be able to get it going forward in the future. Even if I lost money on this transaction, what I need to do is take out another loan, take out another payday loan so I can invest it again. I need to continue along this path because I believe that this is the pathway towards this kind of thing, because all of the incentives and people around me that I trust, all the people using economic language and all the people telling me I'm really smart are the ones that are saying that if you continue to invest in this market, you will then succeed. That is the problem with opening opposition. The next thing I want to talk about is this idea of regulation. I just don't think that inherently understanding something better means that you're going to regulate it more effectively, which is to say, I actually think that in a lot of instances, the fact that people don't understand the economy is why they are risk averse in terms of regulations in the economy. See F 2008, where by their own concession, we did get a lot of regulations in the economy, even if individuals didn't understand it to the best extent. But secondly, it's unclear the way in which they would want to regulate it positively, because of all of the kinds of epistemic links that we talked about there, i.e. the authority figures telling them to do these particular things, are also telling them to vote in a particular way, that's likely to be towards the incentives of those with capital rather than the poor on the ground who are oftentimes being these investors in the first place. We also have already explained, therefore, why it's not just a small amount of your money you invest in these kinds of things, because a rational person would do that, but a rational person just wouldn't have invested in these kinds of things in the first place. A rational individual would have just saved up their money in a bank, held onto it for the long term, maybe not sending their kids to the best college because they couldn't afford it, but sending them to the second or third best. It's inherently these risk-taking individuals who are engaging in this kind of activity. So, first thing that I want to talk about primarily is characterization. We explained to you these individuals are risk takers who are either feared legitimacy of gambling and now believe that because as opposed to poker or slot machines, you can have the ability to control your assets here. You can use your intelligence to these kind of things. We have these kind of arrogant individuals oftentimes engaged in these markets. Maybe sure there's some individuals that are really smart and make a good bit of money on these kinds of things, but there's a vast minority, and we say they would have used those skills in beneficial ways on the comparative anyways to generate beneficial things for themselves. Secondly, we explained to you that eToro and investment sites oftentimes facilitate the buying of shares with things like taking money off of each transaction, and therefore they want the incentive for you to take on a number of different risks rather than having safe investments over the future. So the incentives of the companies which facilitate the trades in the first place is not for you to make money, but for them to make money, which they get by high frequency transactions. Thirdly, we say it's not largely highly educated individuals in this market or the safe investors that opening opposition we want to talk about, because those are the kinds of people who are engaging in this kind of thing before this rise happened, right? Those are the kinds of individuals who had this kind of economic knowledge who are engaging in these kinds of sectors. So, two claims then and two impacts that we brought you in opening government. Firstly, the risk towards the gambler themselves. Three reasons why there's huge amounts of risk. Firstly, if you see my previous analysis, if you have a system across the world which informs the economy, because the economy is informed by geography, by sociology, by politics, and all these kinds of things that exist in interconnected systems that an individual without the capacity to interact with it is not going to be able to properly interpret insofar as they can get things across their own life. Even if you have 100 people on a Discord server, I don't think that makes sense. Secondly, we explain that those with shares want to do pump and dump scams, i.e. using the hype and social media systems that they have available to them to bypass individuals' rationality, i.e. Bitcoin to the moon, diamond hands, you're only a smart investor if you hold on, and then they dump when the price reaches its maximum and the individuals on the ground lose massively. Thirdly, we say they're pushed towards these kinds of high-risk stocks because of the psychological biases that they have engaging in these kinds of things. But fourthly, and more importantly, I just think that the individual companies who have the ability to do things like high-frequency trading, because they're able to use things like language AI, who can read 1 million news articles, to interpret them, and then give you an investment portfolio based off that, are always going to outcompete you. And insofar as it's a zero-sum market, that's always going to happen at the expense of those individuals on the ground. They're able to do things like high-frequency trading using proprietary algorithms that are not accessible towards the general public, to do things like buying and selling stocks using computer algorithms to generate the idea of when an individual stock is likely to go up or down within a very specific market that hurts these individuals on the ground. This means a number of negative things, but secondly and more importantly, I think this is where the product extension comes from DPM, is that there's a huge risk in the market here. So firstly, massively you have individuals on the market, like look at GameStop or Tesla, who play up by powerful actors. This is previous analysis as well, but it's important in this context. High degrees of stock in conventionally stable assets, because they can use their social media power to rile up demand, to increase the asset and crash it, right? And that's the incentive capacity and mechanism for how this happens. Here's the problem though. These stable assets in the market are now unstable assets because you do not know at any given moment whether this kind of thing like GameStop will happen again. These stable assets are problematic because because those are the things that our pension funds are built off of, and like conventional estimates for like investments for like old people or governments, etc. In general markets like the Nasdaq or the Dow Jones are also built up into these kinds of things. But also, just insofar as you have far more actors in the market in general doing certain actions, and you can't rely on their rationality in general, makes the entire market less likely to be able to be predictable. Before we move on to the impacting of this, closing.
Look, I don't know why you think the majority of this trading is day trading. Clearly, the vast majority of this money will go into people who invest for retirement and therefore are able to ride out crashes. Please deal with
But the comparative there is that those individuals would have been investing in pension funds which a company would be holding on to, which I'm just explaining why that's going to be worse off. Two reasons then. So firstly, the individual people get fucked over, right? They can't pay their health care bills. Like an old lady fucking wanting to work into her 80s, like having back-breaking labor cleaning toilets when she thought that she was going to be able to like rest on a beach with her husband because her pension funds had been fucked over by shitheads on Wall Street bets. But secondly, the general market in general is less stable, i.e. wealthy individuals don't invest but hold on to their money. And banks who invest in these kinds of markets no longer are able to rely on the security of those investments, so they need to do things like increasing their interest rates for the general public, i.e. it's more difficult on their side of the house to get a mortgage even if you would be able to pay it off, because you can't pay off the interest rates because the banks have to price in the increased risk into the market into their kinds of pricings in the first place. How should you weigh this then? Firstly, on scale, because we affect not only the individuals who do this trading but also just overall the market writ large, which affects everyone, which secondarily therefore means vulnerability insofar as the people who are worst affected, i.e. the irrational individuals who are fucked over by gambling, but also secondly just the individuals who like get fucked over in times of economic downturn are the working class. But also sufficiency and certainty, because we proved to you the claims in the opening government case that means that individuals are likely to get massively fucked over in the context of these kinds of things. I deeply regret this, and I hope you do too.
I'd like to thank the Deputy Prime Minister for his fine speech, and I'd like to call upon the Deputy Leader of Opposition to continue the case for open opposition. Hear, hear.
Starting speech in 3, 2, 1. I just want to quickly talk about what a trend is. Take people who are fanatical about, like, say, the band Ween. I think these people liked Ween before it was cool and before it was in the SpongeBob movie. I think the people who started liking Ween on the tide of the trend do not have a symmetric investment in the band Ween or the ego engagement from feeling special and unique and smart for liking something different from the rest of the population. So I guess what I'm saying here is that some people are risk takers and some people have been on Wall Street bets since like 2014 before retail investing got really that popular. And I think these are the people that can be convinced that they are super smart and special and making good choices when they're doing really risky, stupid shit. But I think these people don't encompass the trend because they're the early adopters who are like spending their life savings on stupid shit. And I think these people also are the ones who are making huge investments. And I just don't think they're in the debate. But I think also, if these people weren't just trading stocks and this trend did materially influence them into doing more risky behaviors, I think probably in the counterfactual, they would still be taking a lot of risks just on other things in their life. Like they would probably just have gambling addictions, or they would be doing something else that's really fucking stupid with their money, because these are just like people who have no sense clearly. And I think they're probably just a minority, because I don't think that opening government have convinced us that a significant number of people are very fucking stupid. I think additionally, most people are sensible as Jamie analyzes, which means most risky trades, when they do happen, like in GME, are low volume, because there are marginal returns from all of the analysis from OG about people, why they would invest, like the good feeling of being socially included in a movement, or feeling like you're super smart, if you're investing 100 on GME, or if you're investing $1,000 on GME. I think people get about the same utility from both, so I don't think anyone's getting financially ruined by this. And if somebody loses $100 on an investment that didn't work out that well, they might just go, oh well, that was kind of fun, haha, moving on with my life. But I think other stuff is probably just more prominent in this debate, because most people who are sincerely pursuing this as a hobby are going to be investing in things like ETF funds that beat the S&P 500 like consistently, which means they are just making good returns. I don't even think we're reliant on people having perfect information, because there are ways to trade stocks like investing in large funds that already exist, where you can just make a lot of money and it's kind of just like free money, and I think people should do it more. I have to confess something still though, panel. I used to have some Twitter stock myself, and when I found out, however, that Elon Musk was buying fucking Twitter, which is a platform that does a lot of social good, which acts as a town square and has a lot of material effects on global political discourse and democracy, to the extent that banning people like Trump from the platform platform had material effects on his political likability, well, I sold my fucking shares when the deal was announced. I think Wall Street traders deal in huge volumes of trade every day, and if you work in a hedge fund, your incentives are primarily shaped by advancing within your corporate hierarchy, not making a loss for your clients who invested money in the account you are managing, getting massive commissions when you succeed and make money for your clients. I think overall there is no reason to care about market externalities that have broader social repercussions. They take entirely analytical and profit maximizing approaches to trades. I think we do see things in investing like the use of environmental and social governments, but I think this is a plaster to this problem because of the strong small scale incentives. I think the main incentives of BlackRock will at best be pinkwashing or greenwashing when they try to like pander to people who want to improve the world, and there is no way to check these decisions if people have no fucking financial literacy, which is the thing that Jamie proved to you in his speech. How do we solve this problem? I think first we allow individual retail traders to influence corporations directly through the market. They actually have a financial reason from corporations to care about the social repercussions of a market externality if there is backlash. But I think second, critically, this increases people's financial literacy. They learn what a stock is. They learn what common market operations mean. They have an incentive to investigate financial news and now possess the vocabulary to actually understand these things. I have religiously been reading Matt Levine's Bloomberg column literally just because GMA happened and I was kind of curious about it, and now I know a lot about it. Crucially, I think you get all of these benefits even when everybody isn't actively participating in the trades, because when things like GameStop are in the news, you learn what shorting is without even having to actually do it yourself. I think this means that when corporations are engaging in unethical financial practices, people actually know what the words mean. I think this is like creating ESG policies that they don't actually follow, or meddling with the ranking of ESG corporations to the point where you can have like a natural gas company being ranked high on environmental social governance, or things like creating doom trials against corporations that people rely on. I think this looks like seeing a corporation is going through a tough patch or short period of unprofitability and shorting that corporation, i.e. profiting from its demise, which then when larger investors do this, signals to the market to keep shorting it, further pushes the stock price down, and then further increases the likelihood of failure. The reasons why GME happened in the first place is that people who are gamers and who like GameStop didn't want it to collapse because they just like gaming. I think this is also why, critically, even though Jamie has already proven to you that investing will mostly be successful and quite profitable for people, being super profitable doesn't always matter to all of these individuals who have extra market reasons to want to invest, especially when most of these trades are low volume and don't have huge repercussions in their personal lives. Like they hate the social repercussions of a corporation's actions, so they don't want them to do bad decisions, so they make a backlash so the corporation actually has to do something. Or they just like a company and they don't want it to fail, noting that, look, corporations have huge outsized impacts on people's lives, and in the counterfactual, they just have less control over influencing them. I'll take closing. I think this is true when you're investing your pension in it. I don't think this is a contradiction, because I'm mostly just talking about the low volume trades, which encompasses the vast majority of populist trading like GME. We're talking about two cases here. There's people that do it for fun. They do it for fun. They don't really have any huge repercussions when it fails. There's people who do it seriously and make a lot of money from it and get some more financial stability to weather crises. They get to keep, if they lose their jobs, they have a cushion. They can get more returns on their pension. They can retire in more comfort. I think all of this to say, specifically all of this is exclusively accessed when we get the kinds of financial education that Jamie tells you that this specifically prompts. We are able to hold governments to account and corporations to account symmetrically, but we also increase the incentive for governments themselves to have more financial literacy in the types of policies that they are making. Like in the UK, when people aren't allowed to invest pension funds at all in any kind of venture capital, oh, that looks scary. We don't want to do that because that sounds like it's high risk. It's literally the reason why the UK is going through like a productivity crisis. But because people don't understand that like pensions have a large portfolio, which means that they have like different things to hedge their risk, people just hear things that sound risky and they want the government to ban it. And it's really fucking bad for the economy, but it's also specifically bad for productivity and growth, which is why the UK is going through a whole lot of shit right now, and the recession's going to be super bad for all these reasons. Opening opposition.
I'd like to thank the Deputy Leader of Opposition for his fine speech, and I'd like to call upon the Member of Government to begin the case for closing government. Hear, hear.
Panel ready? Starting in 3, 2, 1. The closing government path to victory is the following. We're going to explain structurally why you are unable to compete with these companies and fill in the gap in opening government that only say it is algorithms and never prove why they're not accessible. Secondly, we're going to prove structurally why companies are likely to fail as a consequence of the speculation massively lowering the price, flipping OO but also widening the scale of the impact within this debate. 3 observations on opening opposition. 1 on financial literacy. Just because you have an incentive and aware of things does not mean you have the capacity to be able to implement a regulation with the government. Secondly, financial literacy, if used in a bad context, is not necessarily beneficial for those individuals. Thirdly, for the spin-off effects they say of this, things like in your daily life, I would posit individuals learn this and how to operate, i.e. paying your taxes, etc. I'm not sure about the scale or the intensity of that. Everything else will be integrated. Firstly, why are you structurally disadvantaged in investing? Firstly, connections. Those individuals within those communities often went to university with those people, may have connections with them and deeply understand recommendations from them. Secondly, they may have friends within those companies, may have worked with them previously and then gone and worked for that the hedge fund. Thirdly, you have a history of investments. You often understand what is necessarily a good investment or where the market trends have been positive or bad from your own experiences. Secondly, opening governments say you have algorithms. They say they're not accessible to the general public. Why? 2 reasons. 1, they often have intellectual property to prevent their competitors being able to access them. Secondly, the cost of creation often prices those individuals out. But thirdly, specialization. That is that the experience within the market means you are always structurally inclined to be able to select those decisions far better. Fourthly, money. Let's assume that they are both equally good and take opposition at their best. The problem is, even if you have the best capacity, you can always be priced out by that stock because you're competing with a billion-dollar company who necessarily, if they believe it is profitable and it is a good stock, then they're likely to be willing to outbid you upon that. Secondarily, companies are more inclined to sell it to you specifically because they believe that you will invest in them more in the long term. Fifthly, there's just a time effect, right? Literally, non-professional investors, by the characterization on both top half teams, are individuals who do not spend a lot of time doing this because maybe they're working and that was a prerequisite for them getting things like savings. What that means is the individuals who are literally working 12 hours a day on Wall Street are able to approve those trades in their daily base, on their daily lives, deeply understand the market and just frequently spend more time on that. All of that is to say that if you believe OO and they have some incentives and they're good, or you believe opening government and they have algorithms, irregardless, you are always likely to lose. But secondly, even if it is not even a profit-losing company like opening government say, rather it is companies that are less profitable, I'm also going to explain why that is bad. Why is that bad? Because those individuals are now likely to continue because they see a success story where an individual got a slight profit, maybe 1 or 2%. Now people specifically feel ashamed when they make a loss. That is, they don't talk about the bad stories and always only talk about the good stories, and then the interactions you have, you overweight them. But secondly, you have some success, which means that you're willing to always go forward and forward. So yes, opening opposition may get some benefit, panel, but all of the structural analysis proves that they are always inclined to make a loss in that respect, meaning that the marginal benefit there necessarily is outweighed by the structural harm that they are likely to lose, and therefore that learning, they may view it as a learning experience. Why therefore do companies fail? Before I go on,
If I invest in a stock in an ETF fund managed by a professional investor, I don't need connections, money, or time to make a lot of profit.
I mean, this is going to become wishy-washy because I'm going to analyze that. I don't even think this is comparative because those companies are not non-professional investors, right? They're literally a large company that individuals put their money in. I just think it's an absurd characterization of opening opposition to try claim this. Why do companies fail? Firstly, investors panic. Firstly, you have a limited safety net even with their savings. That is, that you are likely to lose the money even if it's 100 or 200 euro. You are likely to see that go down, and therefore maybe this is your first time investing and are likely to want to sell that stock off. When the comparative companies can hedge against this because often they have much more money and their ability to offset this. 2, OO's mechanism themselves of horror stories means that those individuals fear that it will get worse, i.e. the example of Wall Street, means that they're likely to panic and therefore sell it off. Thirdly, they often lack the experience, so they're likely to speculate that it is lower and not factor in that the market may go up and down, specifically where those investors in traditional companies are able to do so. This makes the stocks volatile. What is the problem with this? Firstly, these individuals sell off their stock, which means it spirals because other people now see the stock price going lower because there's now a higher supply of that stock but a lower demand, meaning individual leverage is reduced and their ability to sell that stock goes lower, specifically meaning they're worse off. Therefore, the price is lower and lower than what the initial initial cost was. What this means is that it hurts the people that both top half team wants to talk about, but it hurts them to a far greater intensity. Specifically because even if you initially only made a 10% loss, as people massively sell off that stock, as they did with GameStop, individuals massively lose shit tons of money because of the structural incentives of individuals to sell it off, and in some cases they cannot even sell it off, meaning they lose the entire investment overall. Secondly, companies cannot raise cash because suppliers view them as relatively volatile and are unwilling to trade with them. They're willing to go to the other company that necessarily isn't being traded by the non-professional investors, meaning your capacity to actually fund your company or function necessarily goes down. But thirdly, traditional investors are likely to leave because the stock is incredibly volatile. That is, that specifically having these non-professional investors that you know can leave at any time, specifically because of the fact they may have a low amount of cash in it, but secondly lack the experience, means they are likely to sell that off, and that's not something you are inclined to do. What are the impacts of this? Specifically the following. One, companies are likely to lose expertise from traditional investors. The type that have experiences in other companies and can give them the advice about how to make that company the most efficient, the most productive, give them things like market access and market research. Secondly, companies are likely to have to cut jobs because to ensure their ability to function. That is that even if they don't meaningfully actually lose the revenue, the perception from them is that it's likely to go down, so those companies have to hedge and make cuts to ensure that they believe that in the future they are profitable. Thirdly, people are likely to lose access to their services because of the fact they may have made cuts in particular areas like jobs and shops. The scale of this means that it affects a huge company, and what that means is individuals are one, likely to lose their jobs, two, have wage cuts that reduces their quality of life, and specifically means that this is a bigger impact because if individuals lose their job and get lower wages, that necessarily per the both top half teams of characterization of a $100 or $200 loss compared to you losing your job where that may be 20 or 30,000 euro a year. Secondly, the intensity impact because the loss of that money spirals within those individuals and therefore they are likely to be worse off. That specifically means the quality of life of those individuals is worse there. Why are people likely to pool their money on our side absent this? Firstly, hedge funds. They want a huge amount of money to access. Yes, in some cases they want access to billionaires or multi-millionaires. But the problem is that when hedge funds are competing and there's multiple individuals who want access to large reserves of cash, they're likely to undercut each other to a massive extent. Why they are therefore likely to be able to then offer that product to individuals who are middle class or middle upper class and therefore be able to access those hedge funds and all of the expertise that I said they were structurally inclined against. Secondly, the bank. That is that at worst case on CG, you leave your money in the bank. You spend it on things that make you happy and things that just make your life better. Compare that to losing the money and you cannot spend that. What that is to say, that means the quality of life of those individuals, they can claim all of the investment want and maybe look into the literacy after they invest in their hedge fund or secondarily spend it on things they want. Whatever they do, we don't care. CG.
I'd like to thank the Member of Government for what was a fine speech. I'd like to call upon the Member of Opposition to begin the case for closing up.
Couple of points on what this debate is and is not about and why I think Gov is just not on Clash. Second, I will look at why it's important for average people to access capital returns market, and that is the most important thing in this debate. Lastly, I will look at why it's a legit way to spend money, even if you lose. The government doesn't get to tell people they shouldn't get to do that. The problem with government is they assume that the market is zero sum, right? So they try to tell you you have to compete with people who do this professionally because they somehow assume most people are just going to be day trading. Here's the thing. The reason why I invest in stocks is because if you buy, let's say, equity in a company that has a factory that operates in a year, that factory will still have the factory, probably maybe even at a higher price because property does tend to increase in price. But they on top of that have $5,000 because they've made a profit from generating economic activity. And then they will buy a second factory and you will now own like 10% of two factories and then another $5,000 and so on. So what happens is not that you buy and if you make a profit, someone else loses. The thing is that in the 2022 capitalist dystopia we live in, where we're all insanely obsessed with economic growth as the only metric that we build our government policies on, you can expect that even if there's a crash, the market will return to a much higher level than it was before. What is distinct on our side of the house is that you don't need to be at the top of the 1% for you to access those gains. That is why I think I've already won the debate as it happened so far, right? And notice, you don't need to compete against professional traders because you get profit, sure, if you sell at a higher price, but the person who buys Sure, they could sell in a crash. I think they're much less likely to sell in a crash on our side of the house, also deal with that. But they're much more likely to hold on to it, and they will sell it in the future for an even higher price, right? So sure, they make less of a profit than they would have made had they bought sooner, because you made the first part of the profit. Maybe they make less of a profit if they buy shares of Apple, who only rises by 50%, instead of in Amazon, who rises by 200% because everyone was ordering in a pandemic. Essentially, however, regardless of of whether you get the biggest profit or not, those individuals end up profiting, and it doesn't have to come at the cost of someone else. That is why I think CG is probably already out of the debate, right? Yeah, also like about the crashing the market, like I'll deal with GameStop separately, but maybe in 50 years, if it leads to such an insane capital redistribution, because average people have actually been able to access capital returns, they will have enough capital to actually crash the markets. But right now, yes, the 2 billion market of individual investors might be twice the 1 billion market it was in 2011, but it's still like 5% of the overall market. So I have no idea how you have the ability to crash an entire market as a person who doesn't know what they're doing. Clearly, sorry government, but I don't think you know how this works. But also, here's the thing, the more people do it, and this is why the increase is significant, because the more people do it, the more tipping points you start to access, right? And here's a mechanism that is missing in opening, right? Because they tell you more financial literacy. Why do they not access financial literacy on the other side? They say, because it's not in the news, and reading the news about GameStop, you learn things. But the thing is, because many people are interested in GameStop, there is profit to be made from teaching people financial literacy in a way that doesn't exist if no one cares about it, right? So that's when you get a lot of YouTube channels that teach you this for free. That's when you get Khan Academy. That's when you actually get newspapers interested in covering it. That's when people have an incentive to do it. Here's the thing. Sure, they could be bought by big finance, whatever, and give you false information, but because it's a bigger and bigger market, there's more and more accountability. This is something you can track. You can see if that stock that person told you to buy crashed or went up, and you can see if that person had equity in it and profited from you buying or not. So, yeah, just to deal with GameStop very quickly, and this is also my argument on why it's a legit way to spend money. Like, I already told you, GameStop buyers all were like under $100. What they don't mention is that they didn't do it for a quick profit, or at least most of them didn't do it. They did it to squeeze the big finance who shorted that stock and was trying to crash that stock because big finance didn't like it. It happened to be that it was a penny stock, so it was really, really cheap. There was very little equity in it. So like, it was like under $1 million, the total that was invested, and it happened to be a sufficient enough share of that for them to be able to sway the price and actually squeeze the short sellers that actually forced them to make a couple of billions in losses in a few days. The thing is, that's not going to happen with the entire market, because there's no fucking way individual investors will have enough money to do that. But those people weren't spending $100 to buy the chance of a quick profit. They spent $100 to stick it to the big guys that stuck them in a weight and that made them lose their job in a weight. They actually bought entertainment and revenge. They bought feeling good about themselves. The narrative was David and Goliath. I think that's $100 well spent, and you don't get to tell me otherwise, government. OO's point on like shareholder, they don't call it shareholder activism, right? They tell you have ESG investing. I think that's weak because they also need a lot of capital. I think what's more important in you buying stock and equity specifically and being able to stock pick without going through like mutual funds and people and like things managed by the people who also control the financial industry is that you get your foot in the door at governance meeting and shareholders meeting. Buying one stock or like one share of a stock is in many companies already enough to get you in, or maybe you invest $500 to get into the shareholder meeting of a bigger company. And that's when you actually do have the ability to make a big fuss about things they do. That's when you actually get press coverage of you being at their meeting, even though you own very little. And then that's when you actually make them scared of what the market is going to do to them. I don't think you can realistically do that on OO because you would have to buy insane amounts of stock in big companies to actually sway them. But you do get this with our mechanism. Actually, yeah, opening, I'll take you.
Legitimacy doesn't matter in a debate like this because of negative externalities. Retail trading is equity, like, I know this is per the info slide. Investors in hedge funds, trust funds, and your pension funds are on our side of the house.
Yeah, okay, look. Okay, here's the thing. In capitalism, I've already told you that, like, capitalism relies on, like, capital returns, right? That means that if you're an individual, you are always going to be outcompeted and outspent by the big 1% lobby. And it's not only that, is that the gap is growing. Because the people who require on their hours in the day to make their income and require on income specifically, one, very high risk because you can lose your job, you can get in an accident. If a crash comes and makes a ton of people lose their jobs, how are they going to find new jobs? It's also pretty hard to increase your salary significantly over the course of your lifetime. Maybe you go for 20 to 40K, but you're never going to go from 20 to 500K income, right? However, if you have capital and if you have equity in a capital, which as a small person you can't really access, you can't buy a house and then rent it out because you're never going to afford that. You can barely afford buying your own house. However, if you can buy stocks and if you can do it on an app that doesn't even charge you a commission, you are much more likely to be able to access some sort of capital returns. Pension funds can default in crisis. The US bonds that you can buy are not going to defund. Inflation just this year is pushing 10% in 1 year, right? Saving in pension funds will not help you. Equity in the companies profiting of this crisis, paying you dividends because they are forced to because you own equity, is how you actually advance as middle class. I just don't think most people are stupid enough to go into day trading because the feedback loop is very quick. Very proud to close.
I'd like to thank the Member of Opposition for his fine speech, and I'd like to call upon the Government Whip to close off the case for closing government. Hear, hear.
Panel ready? Cool. Can I be heard like this? I don't know how much the room can hear, and I found people a bit quiet. Excellent. Okay. Getting started in 3, 2, 1. There's 5 Irish people in this debate, but only 2 of us have an Irish flag. That means we win. Moving on. Firstly, against opening government. I have 2 pieces of weighing I want here. So look, when it comes to the individuals who are going to invest, that both of us want to talk about, some of them might opt for high-risk investments in the way that they talk about. Some of them might opt for low-risk investments in the way that they talk about. We tell you that they are structurally not able to access the investments that are going to benefit them in the best way because of the way in which the market works, in the way in which Jack describes. All of the investments they will be able to access are going to be ones that are less beneficial for them, and these stocks will be ones which are less safe because they invested them in the first place. The fact that we have these retail investors investing in the first place makes those investments less safe ones because they become volatile at the point at which traditional investors no longer think this is worth engaging in. Meaning that we are the ones who explain why it is the case that these investments are not just probably not safe at the point at which they invested in the first place, but secondly, they become less safe as these retail investors invest into them into the future, which is significantly worse harm and shows why this is bad. Secondly, I think we are the team who shows you why companies suffer. And I know this is incredibly important within the debate because regardless of who you think wins the do people lose a little money, they gain a little money clash, it's important to note that the companies that would suffer and would otherwise have gotten traditional investment and all the benefits, the expertise that comes with that, the connections that those traditional investors can give you, which we said and they didn't, why all of those individuals are the ones who would have jobs and individuals within those states who benefit from being in that company. Services only that company could offer, and maybe into the future that could have benefited a vast number of people. The problem is when the companies fail due to lack of expertise, when they don't expand to the point they otherwise could have, they don't hire more people who otherwise would have had jobs, they can't promote people because they don't have the money to give wage increases or better quality of life increases in those areas. The problem is that individuals lose their jobs, the point at which these companies fail, and they have worse lives because the companies never expand to the point that it would be beneficial. That affects everyone at the point at which those services likely would have been helpful, but it's also a much more intense impact given maybe it is true that people are going to invest a small amount of their income because probably they are somewhat reasonable. I would say that this means the impact is less important on that clash, but this is a more important clash for the reasons Jack tells you. Losing all of your income is significantly more important and a much more intense impact on you. It is also irreversible because you cannot immediately find another job, and for that period of time you will have uncertainty, you will have fear, you will not know what is going to happen next for you, and that is a horrible thing for a person to have to go through. But thirdly, I just think it's independent of the profit and loss clash, meaning that regardless of who you think wins that, we win this one. Secondly, let's deal with the member of opposition speech. Firstly, saying that the firstly, they say that Gov assumes that the market is zero sum, etc. I would note the notion that day trading is in the debate only deals with opening government. It doesn't deal with our analysis, which is talking about the structure of the market itself. It's less important for day trading to be the primary factor for us, because the point at which any investment is happening into these particular companies, that is the point at which the companies themselves get worse. Secondly, though, I would note day trading probably is the debate if you look at the info slide and you look at the fact that they say it's investment into companies, into stocks, into shares. I don't think anyone on that bench can claim it's about investment into hedge funds, because at the point at which hedge funds are professional investors, they are not in the debate. Secondly, they say also that investment in stocks means equity into the future and benefits. The problem is there's still a limited number of these stocks. There's two reasons for this. The first is because companies don't want to give up mass amounts of control to investors who are somewhat different to them. Often as well, they're individual investors who might have different specific incentives. But secondly, they don't want to pay mass profits out in dividends and lose the profit revenue they otherwise would get, meaning they don't offer huge amounts of stocks. That means there is a trade-off at the point at which we tell you that you cannot compete to get these stocks if they are good and valuable stocks, because the traditional investors do get them and they eat them up. There's a small number of those stocks because there's a limited number of them, meaning the individuals they talk about cannot access them. Secondly, they say people are more likely to hold on to their stocks on their side. But the problem is people don't buy the stocks that would have otherwise been beneficial in crises because they're scared, and they sell them more quickly because they are afraid of what happens in another crisis. What if there is a situation where the price goes down and continues going down and I don't get any of my money back in the first place? The problem with this is that there's no then stability for these people. They cannot trust that the market is going to bounce back for reasons I'm going to analyse later, which means they are not individuals who are able to trust that things will work out for them and are more likely to drop everything. Thirdly, they say it won't crash the market. But the problem is, if you crash a company, we are the ones who tell you that the company itself gets worse and that leads to the harms. We don't need the entire global market to crash. We tell you the companies crash, and that's significantly worse for the individuals involved in that company. But finally, they say the incentive to educate is created to fill in an OO gap. Two things on this. Firstly, I think the content that tells you about the economy and teaches you economic resources are created at the point when big fucking econ nerds have the resources to make these kind of things. Not like the econ version of Johnny Harris can make videos on YouTube at the point at which he can afford a camera and can afford to do mass amounts of research. Problem is, if you're spending your spare money on stocks, on shares, you are not spending your spare money on these resources to invest into like a small business to do this sort of thing. This means I think you have less time, well, given the things that they tell you take time, but also money to invest into these things, which means that there's less of that content created at the point at which the people who would care about it and create it are doing this and being retail investors instead. But secondly, I think you would educate more on other kinds of economic analysis instead. I would note you would teach about government econ policies. You teach about the things that impact people's individual lives. I would note, I don't think this is transferable economic knowledge just because it's about economics, which means that the fact that you learn about how the market works is only important if people are investing. We say it's bad that people were investing. If they hadn't, the things you would have been taught would have been other kinds of economic analysis, things about tax policies, things about economic trade between certain states, and that would be more beneficial because it's a concrete impact on your individual life, and that is something that's more important to individuals because it actually affects their lives. Meaning I think whatever content would have otherwise been created would have been genuinely beneficial because it would have been something that impacts people's lives in a meaningful fashion. Before responding to OO, I'd love their POI.
Corporations short falling stocks to create debt spirals. It's already volatile. If this is bad, we uniquely counterbalance it.
No. Okay. Responding to them. Firstly, I want to talk about better social mobility. They say that you are able to have low investments, but social mobility high enough that you were able to advance. I would note, if it is a high enough amount of money you are getting from this, that it is a second stream of income, or it keeps you afloat when you lose your job, you must have invested a high amount of money in. They can't have their cake and eat it too. That doesn't make sense. Secondly, I think they have hugely limited time to research the things they talk about. People have jobs 40 hours a week. They have children to take care of. They have other things they care about in their lives. That means I don't think they can dedicate their life to reading the Financial Times 40 hours a week as well as their jobs to be on top of everything that happens in the world of finance. Meaning this is an absurd assertion that you learn more about the financial social mobility just in this way. Thirdly, I think that they are also massively exclusionary. They say you just learn the vocab. The problem is the vocab is exclusionary and meant for people who know about econ and finance. The stats are going to be inaccessible, and companies are going to want to, the hedge funds won't want information to be equally accessible because they want to have a competitive advantage on the market over individual retailers. Fourthly, I think it's a massively speculative market. I would note, even if you do learn stuff from the financial stability, the financial information they tell you look into. Firstly, random things can cause shocks in the market. I mean, look at the Hillary Clinton leaked emails and the fact that those led to individuals, every company that was linked to Hillary Clinton losing stock value because the leaked emails led to her being less popular. That was not something anyone could predict. The second thing is that shocks happen where price drops and the spirals that we talk about take place, meaning that the companies could just become less valuable, and that's something else that they can predict in opening opposition, even if they care about the information that they learn about. They say you're more aware of financial policy, but surely all you do is get educated on investment-based policy, the bit that affects you and your investments, not government economic policy or anything things that would be voting issues. But secondly, I think governments frequently don't regulate the stock market because it's a global market, so I have no idea whether this is any transferability onto government policy or voting issues. I don't know why it's important. Look, proud to stand in closing government and be the only Irish people in this room with a flag propose.
I'd like to thank the government whip for this fine speech, and I'd like to call upon the opposition whip to close off the case of closing opposition.
Ready? 3, 2, 1. For our debate, I thought this was very uncomparative. A lot of people didn't directly compare what the trade-offs are on each side of the house, and I want to actually do that, and I think Miri was the one who brought you this in her speech, which is, me as an average person, what is my alternative to do with the money I have? And I think Miri explains why, one, it is a legitimate choice to use my money, and two, why it's mostly a good choice. I just want to characterize what the alternative is on their side. It's one, pension funds, which you have very little control over. This is like huge companies, etc. And oftentimes they don't adapt to inflation because they very much promise you, you will have 1 or 2% returns, but inflation can be 10%, etc. And note that they especially don't adapt if you don't have a huge amount of people now not doing this anymore, and they have losses because people choose to do other things instead because they see that other things might be more profitable. The second alternative is that they just don't save money for later. I think this is bad because you should have some money in the future, etc. Not it's often very sexy to go to like your 5th majors instead of like saving these 500 euros for later. I think it's much better when you're not forced into making a worse decision for yourself because you don't save money or you do it in worse alternatives than on our side where you have more ability to assess the situations and more ability to actually invest this money better. Note a quick rebuttal to CG. Note that investment funds don't help companies that are publicly traded. Venture capitalists do that. This is not in the debate because that equity is never publicly traded. Note they don't have the incentive to not IPO, but it's unlikely at most you IPO when you have higher valuation. It makes the whole market more stable, which is good. It means people also invest, they get scared by the crypto crash, and if you have the 6th crypto crash in a row, I don't understand why you would then still invest into crypto if you think that this is something unstable. Then on financial literacy, because I think OO does a good job to say there's a need for this, but I don't understand, like, who is this? Who is their unique incentives? Why is this significant, etc.? I think Miro brings to analysis of why there's so many more people who are dependent of a significant rise of people to have the incentive to now post this on YouTube. Because probably the people that OG talks about exist on both sides of the house because they can scam people into this. It's YouTubers, it's Insta artists. And note that these people directly depend on the amount of clicks that they get because they get revenue from like advertisement, meaning that with every click they get more revenue, meaning that you have a much more diversification of views. And note that a crypto, these companies cannot control you if you put something up on YouTube because this is a completely neutral actor and they cannot just like ban you from doing this. Meaning that it is much more likely that you have diversification of views, and we explain why you need a significant more amount of people to have this. Then I think the first question of the debate is, are you able to make these choices? Note, we already tell you why you're able to make this choice better than OO, and they don't really have pushbacks. They mostly claim that the choice you make is bad, and therefore you shouldn't do it. But it doesn't mean that you're unable to make this choice for yourself, or that you don't have other things that you prioritize. To say money is good because it gives you agency. Note, maybe I want to burn my money because I think it's funny how it looks when it's burned. I don't know why it is bad to do this if this is something that I want to see and that gives me like pleasure to that extent that no one else can do this. This is a way that is outside of whether or not this gives me profit or not, because it's something that I personally feel and no one else can tell me what to do. Meaning that we already explained why this is a legitimate choice. And secondly, they tell us, oh, maybe it is a bad choice. I think we need to characterize who invests. I think Abiri tells you. It's mostly very average people. And notice this is where the framing comes in. The normalization and the significant rise of this means that you perceive it as less risky. Meaning that people who perceive this as less risky will now also trade here because there are people who wouldn't have taken this risk in the first place, meaning that you actually unlock the people who don't want to do risky investments. Also, you can have multiple emotions at the same time. OG says, oh, you're irrational. No, you're also irrational to the extent that you think maybe people want to scam you, even if it's a legit thing. So you all probably want to backcheck. You want to know this is your money. Then secondly, on where you invest. This is where they tell us, oh, this is where you have bad choices and therefore they're not good. First of all, I don't think that they tell us a harm other than maybe companies or some big people will pull out and crash markets, etc. I think that this is a huge loss to the companies. I don't see why they would do that. If Miri's analysis is not true, that the markets often come back, especially the stable markets, at a higher price. Meaning that if you hold on to your fund, to your stock, and through the crisis, you're probably going to make a better investment. This means they also don't engage with all of the info slides. They engage with one. But you have government bonds, which are very stable. You have big tech, basic necessities like electricity, water, things that you see that are probably going to be needed by everyone, like garbage disposal. Things like that are super important to people, and people see that. This also responds to the government bench, because you cannot just crash electricity. You cannot go and turn every reactor off by yourself, even if you're Elon Musk. Then this or you cannot just take the factory and bomb it. Probably you're going to have a huge amount of backlash. This is This mechanism is also why financial literacy. You're able to do anything that is stable, because financial literacy doesn't matter if you cannot have stable funds. I think OGOO have a fight over this. Before that, OO.
Yeah, we did not say that everyone is stupid. We analyzed basic psychological biases and the characterization of the people they apply to. Opposition presume everyone is uber rational.
No.
You just lose money.
So you analyze one bias, but we analyze the other bias. Probably both biases exist. Probably, if Milos comes to me and tells me, look, if you pay me 50 euros, you can debate like me, I'll be like, probably not true. Even if I wish this to be true, right? Then, on bad choices, note that Miri gives you the unique analysis why this is not a zero-sum game. Meaning that if I actually profit, maybe I profit less. This is where the margin comes in. But it still means I profit, right? And this is where I can make a choice. Is it good for me to profit 10%, 50%, etc.? It doesn't mean that I necessarily have to make a loss because someone else actually made more profit than me. Then, one moment. Yeah, she also unlocks to you why shareholder activism actually works, because it unlocks happiness in you. Not to tell you, oh, maybe it is good, maybe it's bad. The second thing that tells you, a lot of companies are not that huge. A lot of companies are small and trade publicly. You get now on the table to actually tell them what you don't like, etc. This is where you unlock shareholder activism. This is why it matters. Note, average people matter most because they have because state power principle insert here.
Can we also get a round of applause for the judges? We haven't done the judging yet, but also...